And welcome back to the pricing channel for small businesses. In this video, we're going to talk about wage increases, which is a fact of life for every business that has employees. And we're going to discuss how you determine the impact of those wage increases on your business profitability, and then how to figure out how much you may need to raise your revenues in order to maintain the profitability of your business. Understanding the impact of wage increases becomes particularly important in inflationary times when small businesses are likely dealing with many other cost increases due to our inflationary economy. So let's take a look at how we can go about successfully managing the wage increase issue. In discussing the impact of wage increases, it's first of all important to understand that wage increases can come into our business from different directions. For example, we may offer merit-based raises to employees. These are typically given for longevity. We might also offer performance-based raises based on meeting certain performance goals, and we might also offer bonuses for various reasons to employees. But some wage increases may pretty much be out of our control. For example, market wage rates can increase or decrease depending on whether the supply of labor and the demand in labor is out of balance one way or the other. Likewise, states and even localities can enact minimum wage increases, which will force our wages up if our employees don't meet the new minimums. So, to assess the impact of a wage increase on our business profitability, we need to take the proposed increase that we're looking at and include any other items that might also increase due to the basic wage increase. And so let's take a look at an example to see how this works. So here we have an example of a proposed wage increase. The employee is currently earning $22 an hour, and we calculate what that base wage is on a weekly basis, a monthly basis, and a yearly basis. To the yearly figure, we also add compensation such as workman's comp, payroll taxes, and benefits that we are responsible for paying as a business. In this case, workman's comp adds $1,689 a year to the base wage. Payroll taxes that we pay add $4,224, and benefits we offer to the employee add another $2,112, bringing the base wage of $42,240 up to a total annual compensation or total wage of $50,265. Now, the proposal here is to increase the employee's wage by $2 an hour to $24 per hour. And so again, we calculate the weekly, monthly, and yearly wage based on that new figure. And we also go through and calculate or include the impact from workers' compensation, payroll taxes, and benefits to come up with a new annual compensation or wage of $54,835. Now, when we subtract the current total compensation from the future or proposed compensation, we can see that the total impact on our business will be $4,070 per year or $381 per month. And so, looking at that monthly impact, what this tells us is that this wage increase will reduce our gross profits and it will reduce our net income by $381 per month. And so that is the determination of the impact of the wage increase on business profitability. Now, the second part of the process is what are we going to do in order to mitigate that impact on our business profitability? Well, given that the impact is $381 a month, the challenge for us business owners is to determine how much additional revenue do we need to generate in order to cover that added cost to the business in order to maintain our level of profitability. And as we just discussed in an earlier video, it's really gross profit that we generate that allows us to pay bills. And one of the bills we have to pay now is this extra $381 that is the impact from the wage increase. So, if we need $381 a month in new gross profits to pay for this impact, how much revenue do we have to generate in order to come up with that new gross profit stream of $381 a month? That's really the question that we're asking. Well, it turns out that we can use a pretty easy formula to figure that out. And here's the formula. The new revenue we need to generate to cover the wage increase impact is equal to the new expense, which is that $381 a month, divided by the gross margin of our business. Now, let's just assume that our business generates a 45% gross margin. And as you may recall from an earlier video, gross margin is simply gross profit divided by total revenue. So if our business is generating a 45% gross margin, and we know the new expense, which is the wage increase impact, is $381 a month, then it's straightforward to calculate that the new revenue we need to generate every month to cover the wage increase impact with our 45% gross margin business is $847 per month. That's what we need to generate every month in order to pay for the wage increase we're offering to the employee. Now, the question is how will we generate that $847 per month? Well, there are actually two ways that we can go about generating that revenue. We can generate more unit sales per month in order to generate that revenue. Just sell $847 more of what we sell. Or we can also increase the prices of the things that we sell to a point where we generate that $847 per month. Or another option is we can do some combination of increased unit sales and increased prices in order to come up with that $847 per month in new revenues. In video 7, you might recall, our company, Panhandle Fabrication, generated about $84,000 per month in revenue. Using them as an example, we can see that a price increase of about 1% on their $84,000 a month in revenue would actually generate pretty much that $847 we're looking for to cover the wage increase. So on their monthly revenue, they need a price increase of about 1% to get the revenue they need in order to maintain their profitability. Likewise, they could consider a unit sales increase of 1% per month, and that would do the same thing. Now, which tactic should we be using to increase revenue? Should it be unit sales or should it be price increases? Well, that depends on our particular business environment. If for our business a unit sales increase is the easier route to go, then we should use that tactic. On the other hand, if in our particular business environment a price increase is possible or is easier, then by all means use that tactic to generate the revenue that you need. In some cases, as we've said, a combination of tactics can be used to achieve the desired revenue. In the current example, using Panhandle Fabrication, they could consider a 0.5% unit sales increase plus a 0.5% price increase, and that would generate that $800 and some odd revenue that they need to overcome the wage price increase. So, as noted in the presentation, we have two primary ways to mitigate the effects of wage increases on our business profitability. To generate the revenue required to pay for the wage increases, we can either increase prices, increase unit sales to boost revenues, or we can do a combination of both things. Deciding which of these tactics to use to increase revenues depends on your particular business environment. If you have an opportunity to raise prices, then for sure use that tactic to increase your revenues. On the other hand, if it's easier to increase unit sales, then obviously you want to use that tactic. Now, in some cases where a little bit of both are possible, you can use a mixture of price increases and unit sales increases to meet your revenue increase goal to offset the wage increase effect on your profitability. The important thing is to not let wage increases permanently reduce the level of our business profitability, because profitability is how we are rewarded for the value that we deliver to our customers. We hope you find these videos useful and helpful, so please hit the subscribe button down there so that you don't miss a single video. And for sure, if you have questions or comments about this video or any of our other videos, please put those in the comments section and we'll try to use those in a future video. And as always, I look forward to seeing you again.